Consumer piling up debt, the market piling up gains this year, and all of it happening while the Fed is piling up rate hikes and is likely to do even more. Does something have to give? It's the key question. Let's ask Liz Young, SoFi's head of investment strategy. She's right here with me at Post 9. This speaks to, welcome back. It speaks to the don't fight the Fed versus don't fight the tape. You know, Mester's out today saying, yeah, I would have done 50. Bullard, who's not a voter, but still says, 50 may be needed. Yeah. What do you make of all this now?
Well, you know what's funny is that if you rewind about a month ago, the market was behind the Fed. The market was saying we're only going to get up to, 5, and then we cut a couple times before the end of the year, and the Fed continued to say, no, we're getting above 5, we're going to hold it there. And now here we are. The market finally agrees. So it's almost as if the bond market, the futures have agreed with the Fed. They listen. The equity market, in my opinion, is still not quite listening. And
so
a lot of
you
that.
think it's in denial? The equity market's in denial?
No, I don't think the equity market's in denial. I think the equity market is listening to the data about the consumer. That's concurrent, right? Mm-hmm. That there's retail spending that bounced back, that consumer confidence bounced back, and that services PMI bounced back out of contraction. There are things to be happy about. The labor market is still tight, right? But what I think the equity market is not pricing in at this point, or is not worried enough about, is that the consumer spending, at some point, savings run dry. And wage growth is falling. It can't support that level of spending going forward.
Well, did you see the New York Fed number today about debt, right? Debt's piling up, credit card usage is piling up, delinquencies are increasing. Is that worrisome to you?
Absolutely.
That's like a signal that, okay, this can only last for so long.
Of course.
This consumer strength.
Yeah, and I question some of the narrative around we've got all this pent-up savings. Everybody's sort of sitting on these stockpiles of cash. Well, the savings rate fell below 3%. We're at lows in the savings rate. If all the spending is happening on credit cards in a time when credit card rates are higher than they've been in decades, that's a problem. And at some point, people will run out of money. They're not worried about running out of it yet because they all still have jobs. Mm-hmm. And it's easy to find a new job, and wage growth is hot. But the PPI numbers today, too, did not give me a lot of confidence that inflation is going to continue to come down at the same clip that it has been coming down. I think that's another thing that the equity market is hanging its hat on, saying that, look, it's going well. It's going to continue going well until we get to target, and then we all sort of live happily ever after. And I just don't think it's quite that easy.
All right. So I just want to let everybody know, I told you at the top that there are a lot of earnings coming out. It's Applied Materials, which, by the way, is out. We're going through it. Our reporter is going to come on in a moment. We're going to see exactly what the stock is moving. We got Dash coming out, DraftKings as well, and we're keeping an eye on those balls too. So we're not going to miss any of that and give you everything that you need to know there. Yesterday, Victoria Green was on the program, said this is the start of a new bull market. And you have been very, open and honest about feeling run over by this market to start the year, right? Position sort of thinking differently of how it was going to go. So given what she said about this new bull market where you've been, how does it all play out here then?
So I think the fight the Fed versus fight the tape is also fundamentals versus technicals. There are a lot of technicals that would signal to people that maybe they look similar to they have in the past during a new bull market. I'm still not in that camp. I think that we're probably supported in this range between 4,000 and 4,300 on the S&P until and unless something bad happens, or until and unless the Fed says, you know what, it's not going the way that we thought. I don't think that a bull market starts at this point in the cycle. I still think that you have to get to the point where the Fed at least pauses. You have to get to the point where at least some of the demand bakes into the data in the economy. And I think the valuations at this level, you don't see a new bull market starting 17, 18 times forward earnings. I mean, then it's like, where are we headed to?
So when
25?
people say, well, what if this time is different? And you just don't think it is?
I think that the rally that we've seen so far this year has been very rate driven. I'm not saying it wasn't true, but I think it was very rate-driven. We saw rates come down quite a bit. We saw growth rally. If you look at the sector makeup of that rally, it is all that rate-sensitive stuff. And then even just the sell-off today, almost perfectly patterned in the opposite direction, right? And the sell-off today, I think, was the Fed comments. It was also PPI, so that's rate-driven in the other direction. If it's rate-dependent and we're headed higher in rates, then what we've seen, this rally is not necessarily a new bull market that's taking shape.